Welcome back to Talk Tickers. It is Monday, January 26, 2026. Today, we are digging into a company that seems to be having a bit of an identity crisis in the market.
It's a real Dr. Jekyll and Mr. Hyde situation, for sure. We're talking about Steel Dynamics, ticker STLD.
And if you were watching the tape this morning, you probably have whiplash. The stock, it pops almost 3% pre-market, looks great. And then the bell rings.
Total reversal, just cratered. Finished the day down, about 4.5%, right around 173.
Exactly. So that's the big tension, right? You've got this, quality operator that beats on profit, but the market, the cyclical tape, just punishes it for a revenue miss.
That's the conflict we need to unpack. Is this a great company at the wrong time in the cycle, or is the market missing something huge?
Well, we've got a lot to cover to figure that out. We'll hit the numbers, obviously, but the real story here seems to be this pivot into what we're calling the aluminum era.
Oh, absolutely. And we can't forget the corporate warfare. I mean, the CEO, Mark Millett, he really went after a competitor on the call. It was something else.
To put it mildly. Okay, so let's start with the basics, the results. Q4, full year 2025. Why did the street hate this report so much today?
So it's all about where you look. If you just look at the bottom line, profitability, they crushed it. GAAP EPS came in at $1.82.
$1.82. And consensus was where? Like 170?
Yeah, right around 169, 170. So it's a solid 7% beat. You'd think that would be enough.
You would think. In this industry, a 7% beat should get you a nice green day.
Yeah.
It shows they're running the business efficiently.
Right. But then you look at the top line, the revenue. It came in at $4.4 billion.
And the street wanted?
About $4.53 billion. So, it's a miss of over $100 million.
And then there it is. That's the scary number for a cyclical company. An investor sees that, and their brain just screams, demand is falling off a cliff.
That's the algorithm for you. But you have to add some context. For the full year, they did $18.2 billion in revenue, $1.2 billion in net income. And get this. They shipped a record 13.7 million tons of steel.
Wait, hold on a second. Record volume. How do you ship more steel than ever before and still miss on revenue? That means the price.
The price per ton got hit, exactly. In Q4, average selling price was down $12 from the quarter before to about $11.07 a ton.
And their costs. Did their input costs drop too?
They did, but not as much. Scrap was down only about $7 a ton.
So there's your margin compression, the classic squeeze.
It is, but, and this is the part that makes the sell-off so confusing, they're still a cash flow machine. Full year cash from operations was $1.4 billion.
And what are they doing with all that cash? Just letting it sit there?
No, not at all. They're returning it aggressively. They bought back $901 million of stock in 2025.
$900 million. How much of the company is that?
It's over 4% of their outstanding shares in 1 year.
Wow. Okay, that's a huge signal for management. You don't retire 4% of your company if you think your stock is about to fall apart.
My point exactly. And they still have over $2.2 billion in liquidity on hand. So the drop today, it really feels like it's all sentiment. The market sees a revenue miss, it sells. It's not looking at the underlying cash generation.
It's like the market is looking in the rearview mirror at last quarter's steel prices while the company is trying to point everyone's attention to this huge pivot coming down the road.
And that pivot is aluminum. This is the whole story for 2026. For years, STLD has been in this heavy investment cycle, spending billions.
Right. CapEx has been a drag on the stock. Investors hate seeing all that money go out the door.
Well, that's shifting. We're moving from investment mode to what management is calling harvest mode. CapEx is projected to drop way down in 2026 to around $600 million.
Harvest mode. I like that. So the spending stops, the new plants turn on, and the free cash flow should theoretically just explode higher.
That's the bull thesis in a nutshell. And the aluminum mill, the ADI project, it's not a theory anymore. The big update was that the mill was actually EBITDA positive in December of 25.
It's already profitable. I thought these things usually bleed cash for the first year or so while they ramp up.
That's the normal way, yeah. But they shipped 10,000 metric tons in December. Proof of concept. And the CEO, Millett, he actually updated guidance. He now expects them to hit 90% utilization by the end of 2026.
90% by year end. That feels incredibly fast. Is there really that much demand?
The demand is there, and they seem to be executing flawlessly. They're already shipping product to the auto sector. And here's a little technical detail that really matters. They're bringing 2 new cash lines online by the end of this quarter.
Okay, you can't just throw out an acronym like SASH on an earnings call and not explain it.
Right, sorry. It's continuous annealing surface hardening.
Okay. And in English, that means?
It's a really high-end finishing process. It's what you need to make the aluminum strong, but also formable enough to be stamped into, say, a car door or a hood. This is the equipment that gets you those high-motion auto contracts.
Got it. So getting those running and certified this quickly is a big deal.
It's a huge deal. Automakers are notoriously slow to certify new suppliers. The fact that STLD is blowing through that process tells you the quality is there.
So let's talk about the bigger picture for aluminum. I mean, you can build the best plant in the world, but what's the market like?
The market is, let's just say it's been set up perfectly for them, thanks to tariffs. Do you know what the current tariff rate is on aluminum imports?
I know it's high, but I don't know the exact number.
50%. 50.
50. Wow.
So it's basically impossible to profitably import this stuff.
Wow.
At the same time, the U.S. has a domestic deficit of about 1.4 million tons of this kind of aluminum sheet every year.
So you have a massive shortage and a giant wall keeping foreign competition out.
And Steel Dynamics is firing up the newest, most efficient plant in North America right into the middle of that protected market. It's a brilliant strategic position.
And it adds a defensive quality to the business too, doesn't it? It's
Right.
not just car parts, it's beverage cans.
That's the other key. It provides a counter-cyclical balance. Steel is tied to construction, which is cyclical. But people drink soda and beer whether the economy is good or bad.
So the cans are a stable floor for earnings.
Exactly. It just makes the whole company much more resilient.
Okay, so that confidence, the cash, the new plant, the protected market, it probably explains what came next on the call, the corporate drama.
Yeah, this is the fun part.
I mean, earnings calls are usually so dry, so polite, but Mark Millett basically took a sledgehammer to one of his competitors, BlueScope.
It was pure calculated aggression. I loved it.
So paint the picture. What's the backstory here?
Yeah.
Why the bad blood?
Okay, so STLD teamed up with an Australian partner, SGH. They made an all-cash offer to buy BlueScope entirely. The plan was for STLD to then buy the U.S. assets from SGH.
So they were after BlueScope's American mills.
Yeah.
Specifically their North Star mill.
Exactly. And BlueScope's board just shut them down. Rejected the offer flat out, no discussion, said it wasn't enough value.
And Millett did not take that well.
He took it public on his own earnings call. He just completely dismantled BlueScope's strategy in North America. It was incredible.
I'm looking at the transcript. He called their North Star mill a stranded asset. I mean, that's a brutal term in the industrial world.
It's a devastating insult. He's saying the mill is stuck making basic commodity-grade steel because it doesn't have the high-end coating or galvanizing capabilities attached to it. It can't move up the value chain.
He's basically calling it a dinosaur.
Pretty much. And then he twisted the knife. He pointed out that BlueScope just had to write down nearly $500 million Australian dollars on their separate coating business. So he's making the case that you guys have a failing coating business over here and a steel mill over there that can't make the right product for it. You don't know what you're doing. He even called them out for paying a special dividend instead of investing.
So he's telling BlueScope's own shareholders that their management is incompetent.
He is. He's sending a signal. We are the logical owners of these assets. We can run them better than your board can. It's an attempt to publicly shame them and maybe even stir up some shareholder activism over there.
It's an incredibly bold move.
Yeah.
But it also tells you that STLD is on the hunt. They have that $2+ billion in liquidity, and they're ready to make a deal.
They're hungry, but they're disciplined. They're not just going to throw money away.
Okay, so let's shift from the M&A drama to what's happening on the ground. Because STLD had its own little drama in January at their big Sinton mill.
Ah, yes, the elephant in the room. They had a transformer failure. And not just a failure, there was a fire.
A fire at a major transformer.
Yeah.
That sounds like a multi-week shutdown minimum. That could kill a quarter.
Normally, yes, it could be catastrophic.
But what happened?
This is where they showed off their operational chops. They were back up and running within 12 hours.
12 hours? How is that even possible?
They had spare transformers on site, ready to go. They had to plan for this exact contingency. A couple years ago, when Sinton was just starting up, this would have been a disaster. Now it's just a Tuesday.
So they turned a potential crisis into a flex. But still, they did miss on volume in Q4. What was that about?
That was real, yeah. They had planned maintenance outages at 3 different flat-rolled mills all around the same time. That cost them about 150,000 tons of production.
Why schedule 3 at once? That seems like, I don't know, poor planning.
Management said that's just how the schedule fell, but they were adamant that this was a temporary issue, not a structural demand problem. The orders were there, they just had the machines turned off to do the work.
Okay, fair enough. So looking ahead then, what's the macro picture look like? Are people actually going to be buying all this steel and aluminum in 2026?
Management sounded pretty optimistic, especially about non-residential construction, and not the stuff you'd think, like office buildings. They're seeing huge demand from tech infrastructure.
You mean data centers?
Data centers for AI and cloud computing, exactly.
And it feels like every CEO has to say AI on their call these days. But for steel, it's real, right? These things are huge metal boxes.
They are massive consumers of steel. And then you add in all the manufacturing onshoring, building new factories. That's another huge tailwind.
What about the auto market?
That's a little more flat. They're expecting 2026 production to be about the same as 2025. But the good news is dealer inventories are still really low, so there's not a big glut of cars sitting on lots.
And energy.
Solar is the surprise standout. The demand for steel racking for solar farms is apparently very, very strong right now.
Okay, so let's tie this all together. Let's get to the so what. The stock dropped 4.4% today. The market is scared. Why should an investor look past that?
Because the market is focused on the wrong thing. It punished the stock for a backward-looking revenue number and a generalized fear about the steel cycle. That's the short-term noise.
And the long-term signal.
The long-term signal is that the heavy spending is over, CapEx is falling. At the same time, their structural underlying profit power is going way up. They're adding what they think will be an extra $1.4 billion in annual EBITDA just from these new projects once they're fully ramped.
So costs are going down while earnings power is going up.
And the result is that free cash flow is set to explode in 2026, which means more buybacks, bigger dividends. You're getting a growth story that's being priced like a company that's about to go into a downturn.
And they're doing all this while keeping their debt super low, under 2 times leverage.
It's just a really clean story of a company about to enter a massive cash harvest phase.
All right, which brings us to my favorite part of the deep dive. The part where we offer up a trade idea that is definitely not financial advice.
Let me say it loud and clear for the lawyers. This is not financial advice. For entertainment purposes only, do your own homework. But if I was going to pitch a trade...
What's the trade?
I'm calling it the spite arbitrage.
The spite arbitrage. I'm in. Tell me more.
It's simple, and it's based entirely on Mark Millett's public takedown of BlueScope. You go long Steel Dynamics and you go short BlueScope.
A pairs trade. Betting on the winner and against the loser.
You're betting on operational superiority. The thesis is that STLD is going to execute on this aluminum ramp and just print cash all year. Meanwhile, BlueScope is going to keep struggling with their stranded assets. The valuation gap between the two should just get wider and wider.
And it hedges you a bit from the overall steel market, right? If steel prices collapse, they both go down. But BlueScope should, in theory, go down more.
Exactly. And if steel prices rip higher, STLD should capture more of that upside because they're a better operator.
And there's always the chance that STLD comes back with another offer for BlueScope, a hostile one this time.
That's the kicker. That puts a potential floor under the valuation. But honestly, the core of the trade is just a bet on pure spite. You're backing the CEO who had the guts to call out his competitor's incompetence on a public forum. You have to respect that conviction.
It is betting on the alpha in the room. All right. Again, don't sue us, but it's a fascinating way to look at it.
It's what makes this stuff fun.
So to sum it all up, Steel Dynamics missed on revenue, the market panicked. But if you look deeper, the spending cycle is over, a brand new aluminum cash machine is just turning on, and the CEO is playing hardball.
The revenue miss is today's headline. The cash flow story is what matters for the next 2 years.
Check your own charts, try to ignore the noise, and join us next time for another earnings breakdown. Keep your portfolios green and your steel stainless.
See you next time.